Let's talk to Mike Ingram. He is the Chief Market Strategist for WH Ireland. Very good morning to you, young Mike.
Morning, Moose.
Right, in terms of strategy, this week's been horrific. An amazing start to the year. We saw record inflows into equity markets, big headlines. You know, this was going to be another fantastic year. Here we are coming into the end of March, Q1, and it's a different picture, right?
There's a lot of red ink out there, I'd have to say. Yeah, I mean, this latest episode of weakness actually feels rather different from what we saw in February. Obviously, if you're an end investor, you don't care. Well, I'm down on the month again. Yep. I don't really care, but I think it's important to understand perhaps what is going on, because that might give some clues as to what's going to happen next, or at the very least try to avoid the worst of the fallout. So to roll it back very quickly, January, it was like great guns, you know, as you say, economic growth picking up, EPS estimates moving up for most companies, you know, plenty of momentum in the market, etc., etc., etc. Actually, not much of that has changed in the intervening 2 months, I'd say. You know, if you look at the earnings estimates, for instance, of most companies, they are still moving up. I mean, Japan, US are actually leading the way. Of course, a lot of the US story has been about tax cuts. You've seen actually some modest earnings upgrades in places such as the UK. So overall, the earnings looks okay. The economic forecasts look okay as well. It's probably fair to say that the European growth has probably topped out. Most of the PMIs seem to be coming off a little bit, but you know, I mean, I don't think there's any real risk to the growth forecasts which are out there at the moment. So it's something else going on. Now in February, I think, to a large extent, we've spoken about this before, a lot of it was about this short volatility trade, and we know there are a number of vehicles that were available to retail investors, among others, to funnel that short vol trade into the market. And, you know, that caught up in a situation where all of a sudden the market wasn't quite certain where central banks were going, why they were doing and saying the things that they were doing, this so-called reaction function. Our good friends of the Bank of England, obviously at the forefront of this confusion, moving the goalpost in their February meeting. And that just caught a lot of people very, very short. And, you know, you had this massive, you know, short vol unwind, whacked pretty much everything. You know, to some extent, we were living with the consequences of that because, you know, a lot of the momentum traders were just taken straight out of the market. And it was very clear a lot of investors, having felt that pain, wanted to buy some protection. So that, you know, you could see that in sort of the skew in sort of derivatives markets, people buying puts and protection and so on and so forth. Anyway, if we go back sort of closer towards, shall we say, into March, we've obviously seen another dip down, but in contrast to February, where, you know, we were seeing equity markets go down and bond markets also go down at the same time because people were worried about inflation and they were worried about central banks yanking rates up. This time, we're seeing equity markets go down, but bond markets are rallying. And this is even in the face of just this week, you know, Federal Reserve saying we are going to raise rates more than the market had been expecting. Yeah. Okay, they just about avoided a 4-hike dot plot this time round. If you look at the distribution, it's quite top heavy, but they're definitely more aggressive going into 2019 and 20 and beyond. Now, you could say, well, the market never believes them, but you know, this is what they said. And how did the market react? 2-year yields went down. Bond yields went down. So, and you had a similar reaction to the Bank of England yesterday. We're also a little bit more aggressive. The market, for some reason, was expecting 9-0 vote, 7-2.
Yep.
You know, that's what I thought was going to happen anyway. But there you go. And again, the same market reaction, because the broad issue is this is more of a risk-off trade. It wasn't really it wasn't a classic risk-off trade in Feb. That was more technically driven. As I said, I think it was more driven by central banks. As I said, it wasn't consistent with what you were seeing in bond markets. The inflation story in February was only about 30% true, as I think I mentioned last time we spoke. And in fact, inflation expectations since then have actually, if anything, come down a little bit. So, you know, this is classic risk-off. The only shoe which hasn't dropped in that risk-off trade at the moment is that credit markets have been relatively well behaved. You know, so for instance, the spread between high yield and investment grade has been pretty stable. If I were to see that continue, then I would hope that we'd see a bit of stability come through, because I say at the moment, the growth story is still intact. Obviously, we start to see credit markets blow up a little bit. And I think, you know, you've spoken earlier about things like LIBOR OIS. Again, I think there's some technical things going on with repatriation, dollar flows and so forth, which is helping to boost that. But, you know, as with technical analysis, if everybody believes it's going to be true, it's going to be true. If we're in a situation where, should we say, the average consumer or even a business investor believes that things are going, you know, the outlook is deteriorating significantly, then that is going to affect their consumption. That's going to affect their investment. That's going to affect their employment plans. So the thing that they worry about actually becomes a reality. But they, of course, I know it's all a bit circular and it's all a bit behavioural finance. But this is the situation that we're in. What I want to reiterate is this market reaction is not a function of, you know, all of a sudden growth forecasts falling off a cliff, or inflation forecasts suddenly shooting up, or, you know, central banks suddenly saying, oh, we're going to do a hell of a lot more than we thought we were going to do. This is about just something which is a bit more risk off. And to, you know, as to the source of that risk off, I'm afraid I'm going to have to lay that at the feet of the Donald, I'm afraid. You know, this is something that markets, I've said this again and again over the last, I guess it's 18 months, markets have become completely desensitized to political risk. You know, we had this wonderful narrative ahead of the US president election. We go, oh, Hillary's the candidate. Hillary's the market-friendly candidate. Trump gets in, it's going to be a disaster. And then within 24 hours, and you think, what a bunch of hyenas some of these people are. You know, oh, it's going to be great. He's going to cut taxes and da-da-da-da-da. And it's like, oh, yeah, okay. So faced with the reality of the situation, you spin it positive because that's what you have to live with. The trouble is if you see the developments over the last few weeks, even by the White House's current standards, wow. I mean, John Bolton as National Security Advisor, this is a guy who penned a piece in the Wall Street Journal the end of February saying that the United States would be legally entitled to make a preemptive strike, nuclear strike, on North Korea. Yeah, and this is the guy that's got the president's ear at the moment. That, I would suggest, is quite worrying.
All about politics.
It is, I think, at the moment.
Mike, on that note, thank you very much.
Pleasure, Moose.